This is Odisal Associates, Accounting and Finance Tutors. Again, we are going to solve the second past question on ratio. Question 2. The capital employed by two different companies were as shown below. Rhoda Limited in Naira, Holiness Limited in Naira. Ordinary shares of 1 Naira per share, 400,000 for Rhoda Limited, 1 million for Holiness. 6% preference share, 450,000 for Rhoda Limited, 0 Naira for Holiness Limited. Total, 850 for Rhoda Limited and 1 million for Holiness. Retained earnings, 500 for each of the companies, 500,000 for each of the companies. Shareholders' funds, 1,350,000 for Rhoda and 1,500,000 for Holiness. 9% loan notes, 1,150,000 for Rhoda, 600,000 for Holiness. Capital employed, 2.5 million for Rhoda and 2.1 million for Holiness. Required. 1. Calculate the gearing and return on capital employed ratios of each company, stating in each case whether the gearing is low or high. Explain what that means and also the meaning of the results of the return on capital employed, ROCE. 2. Calculate the maximum percentage dividend on ordinary shares, which each company should declare without utilizing or adding to accumulated retained profits. If profit for the year was profit before loan notes, interest and corporation tax. We have two scenarios. A, 275,000. B, 550,000. Assume corporation tax of 50% of profit for the year. 3. State what conclusion you can draw from your calculation of B2 above. I have carefully written it on the board to save time, because if I have to be writing and talking, it will take quite a lot of time. We're going to start with question 1 by calculating the ROCE and gearing ratios. In this question, ROCE will take two ratios per company because it's dealing on profits. And then we have two different profits for one company. So we're going to calculate 4 different ratios at different times for ROCE, and then we're going to calculate 2 ratios for gearing, 1 for each company. Okay, so here we have been given profits before interest and tax, profit before loan note interest and tax, which is 275,000 and 550,000. So we're going to, the profits before interest and tax have already been stated. And in Rhoda and in Holiness, they have the same profit before interest and tax. And the first scenario is 275,000 for each of the companies. And our ROCE is earning before interest and tax over capital employed. Here, the question has given us capital employed and earning before interest and tax. So we have to compute for 275,000 naira profit. For Rhoda, we have 275,000 over the capital employed of Rhoda, which is 2.5 million. And for Holiness is 275,000 over the capital employed of Holiness, which is 2.1 million. It gives us 0.11 for Rhoda and 0.13 for Holiness. So what it means is that the earning before interest and tax for Rhoda on the capital employed is 11%. And for Holiness is 13%. If you look at the outcome of it, there is a difference of 0.02%. Now, this company has preference shares and this company does not have preference shares. So, in computing the return on capital employed, the bottom line or the denominator of the company that has a preference share is heavier than the other company that does not have preference shares. That is why you have seen that in this place, capital employed is making less of earning before interest and tax, while in this other place, capital employed is making higher. This is because preference share is not there. And you have seen that there is an increase of 0.02% for Holiness in this issue. So the capital employed of Holiness is earning higher than the capital employed of Rhoda. The second scenario is 550,000 naira profit, where we say 550,000 over 2.5 million and 550,000 over 2.1 million, as the case may be. The answer gives us 0.22 and 0.26, which is 22% and 26%. If you look at it, there is a difference of 0.04%. 0.044%. Now, look at the increase in profits. The increase in profits is about 50%. The increase in profit is 50%. But however, if you look at the difference here, it's also 50%. The profit has increased by 50%, and the difference here is also 50%. We go to gearing ratio. Rhoda Limited and Holiness Limited. We start to compute the total fixed fund. Total fixed fund that does not belong to the owner of the business. So we have 6% preference shares of 450,000 for Rhoda, while Holiness have no preference share. They will have 9% loan notes for Rhoda, 1,150,000, and then Holiness has no lower 600,000. If you add it up, you have the total fixed fund for Rhoda and total fixed fund for Holiness. We are asked to, and then the ordinary shares is 400,000 for Rhoda and 1 million for Holiness. We are asked to calculate the gearing ratio. So we have total fixed fund over ordinary shares. In this place, it will be this over this, which will give you 4:1 and 0.6:1. You can see that Rhoda's gearing is very high because of the presence of the preference shares and the high loan notes that they have taken. What it means is that their business is financed more by debt, equity, than by their own investment, the shareholders' investment. So Rhoda Limited has borrowed money such that his loan that has fixed interest is 4 times their own equity. His loan that has fixed interest is 4 times more than their equity. These people are actually doing what is called trading on capital. They are using their capital, their assets, to borrow money. In this point, it's always the business is at a risk of not being able to borrow more money because they are already highly geared. The business is at a risk of not making much profits because they will pay quite a lot of interest at the end. But in this place, we saw that the owners of the business are investing, using more of their own funds to finance their business, not borrowed funds. They're using more of their own fund to finance their business. That is why you see that their gearing is low. They have a low gearing. What it means that they are borrowing less money. Their business is being financed by their own money that is brought by their shareholders. So in this place, the gearing of Rhoda Limited is high and the gearing of Holiness Limited is low. We've solved the one. Let's look at the two. Calculate the maximum percentage dividend on ordinary shares which each company could declare without utilizing or adding to accumulated retained profits if profit for the year was as stated here. So the first thing we need to do is to know what is available to the owners of the business, the ordinary shareholders that are going to partake in dividends. So for us to do that, in that profit that we have that is stated there, we're going to remove the interest that should be paid to the loan notes holders and the interest that should be paid to the preference shareholders. So we have two scenarios, A and B, for the two companies. Profit before loan notes and tax, as stated in the question. In Rhoda, we have 275,550 and the same for Holiness Limited. Then we're going to remove the 9% loan note interest. Of course, the loan note, 9% loan note interest will be calculated from the loan note. I think, from the amount of loan notes. The amount of loan notes we have here is 1150000. So if you multiply it by 9%, you have this amount, 103,500. The same for A and B. The loan note is not going to change whether they have made higher profit or lower profit. It's the same amount of loan note. So that is why you have it. For Holiness, it is 600,000. The 9% of it is 54,000 for the two scenarios. Then if you remove it from the profit, you have net profit before tax. So you now remove the tax. Tax is 50%, so it's just this divided by 2, all these ones. So you have this amount here. So you have profits, the net profit after tax. After you've gotten your net profit after tax, that's when you consider the preference shareholders. So the preference shareholders is a preference 6% preference shares dividend. You calculate 6% on the preference share. The preference share is 450,000. 6% of 450,000 will give you 27,000 and 27,000. this holiness does not have preference shares. So after that, you remove it from the profits after tax to get what is available to the ordinary shareholders. So it is from there that you can now calculate the maximum percentage dividend that can be paid to the ordinary shareholders. So for Rhoda, the profits after you have deducted the dividend of the preference shareholders for scenario A is 58750, and the other shares, the number is 400,000 because the share is said to be 1 naira per share. So since it's 1 naira per share, the value and the unit will have the same number, 400,000. So you have 14.69%. Then here, the profit that is related to the ordinary shareholders is 196,250 by 400,000. We have 49.0.6%. These are the maximum shares that can be paid without either touching the retained earnings that was in the company or adding to it, which means the total amount that was made that period. If you can see, we already have retained earnings of 500,000, which we did not use. So if we want to pay everything 100%, this is what the percentage we are going to pay. Now, we also have holiness. As we have seen, the amount available to the shareholders is 110,500 over their share, 1 million. And then in the second scenario, 248,000 over their shares, 1 million. So you have 11.05% and 27.56%. So the earnings per share for Rhoda, okay, I think it's 69 kobo. 14 naira, 69 kobo. The earnings per share for Rhoda in scenario B is 49 naira, 6 kobo. For holiness, the earnings per share for scenario A is 11 naira, 5 kobo, while for scenario B for holiness is 27,056 kobo only. So these are the maximum dividend that can be paid without touching, either increasing or decreasing the retained earnings. Then the third question is asking us to say something about what we have solved. Now, if you look at what the owners of the business are getting in Rhoda that is highly geared, you will see that as the profit increase, their what is available to them will be multiplied by 3 or more. Look at 49 naira, or 49 naira divided by 14. That will be almost 3 times or so, or 4 times. Then if you look at holiness, you'll see that this is just about 2 times what they have here. So the holiness, the Rhoda that is highly geared returns more to the shareholders than the holiness that is less geared. So sometimes you might think that if you are using your own money alone to run your business, to finance your business, that you make more money. But in this case, we have seen that it is when they geared higher that they made more money to the shareholders. So it does not actually mean that you must use your fund to run a business. Most of the time, management prefer to borrow money. When they compute their ratios like this, by the time they compute their ratios, they'll be able to make decision whether they should use their own money to finance the business or they should go outside to borrow fund. In this case, you can see that it is better to borrow fund outside because as your profit increases, the return to the ordinary shareholders doubles or goes more than a quadruple, as the case may be. So that is the solution.